Good afternoon, everybody. First of all, I'd like to welcome you here today. Today is our first 2018 webinar at Eganberger and Weiner. My name is Carmen Wu, and I'm one of the advisors here with EBW. Our firm endeavors to provide our clients with topics which will enhance your knowledge and give you a variety of financial planning topics. And today's topic is the 2018 Economic and Market Outlook. Now, this presentation will be given by Samantha Azzarello, who I will introduce here shortly. But first, I have a couple of housekeeping items that we'd like to go over. As you can see on your screen, we have listed a L. Reed email. That's Logan Reed's email. So that is an L, actually. We will be taking questions at the end of Samantha's presentation. So if you can do me a favor and jot down that email. So as we go through the presentations, if you have any questions that pops in your mind, please write it down and send it to Logan Reed at ebwllc.com. We'll show this his email again towards the end. Now, the next page, as you can see, is the disclaimer. If you can take just a couple of seconds and read through the disclaimers for our presentation today. Okay, I know you're all speed readers, so I'm sure you've gone over that. And now I would like to go ahead and introduce our speaker. Samantha Azzarello, as you can see, is Vice President in the Global and Markets, and is a Global and Market Strategist at JP Morgan. Samantha develops and communicates timely market and economic insights to retail and institutional clients across the United States. And as you can see, she's been with JP Morgan since 2015. She joined the firm shortly after she had been working previously with Bank of America, Merrill Lynch, Wealth Management, and in that particular position, she was involved in formulating and communicating the firm's economic and market outlook, as well as allocating views. So with that, I'm going to go ahead and have Samantha take over the presentation. So Samantha, with that.
Great. Thank you, Carmen. I'm very excited to be talking to all of you this morning. We're going to make sure to leave lots of time for questions because I think there's no shortage of things to talk about, and we want this to be more of a dialogue. Right, so everything around markets and the economy is in our Guide to the Markets, which is our flagship product at JP Morgan. It's our research, and we don't do any product. All we do is look at the markets, look at trends, and try to figure out what's going on. So that's what we're going to talk about for the next 40 minutes or so. If you just move to the next page, we want to start really with the U.S. economy because everything begins and ends with the U.S. business cycle, whether we're growing or shrinking, strengthening or heading to a recession. So what's the take on this? For 2018, we don't see a recession on the horizon. We actually see an uptick in growth, right? A little bit of an acceleration. And I just want to point out a little bit of economic history that I think is really relevant on the right-hand side of this page. So what are we looking at? Strength of economic expansions going back to 1948, which seems boring, but it's actually very relevant because it provides a little bit of a roadmap going forward. So each line represents an expansion. The longer the line, the longer that expansion was, or the longer the period we were growing. The steeper the line, the stronger the growth rate associated with that expansion. And off the bat, you can see a few things. The first is that most expansions kind of looked the same, okay? That's that cluster of lines. Now, the growth rate associated with that group of lines, or that group of expansions, was about 3%. So forever and always, we were a 3% growth economy. Now, one of these things is not like the others. That's the light blue line, which is diverged away from the group. Now that light blue line is the expansion we're currently in. And the growth rate associated with this expansion has been slower. It's been about 2%. So 3%, 2%, does it matter? Does it make a difference? I would say in any one year, right, in any single year, it doesn't really matter if you're growing at 3 or 2, but it does over the longer run when it compounds year after year after year. And we've been growing consistently slower since 2008. Now, this is truthfully just the sign of a maturing, aging economy, which is what we are. And I know some people would like us to grow faster, and that's actually in the cards for 2018 because we've been getting good fiscal stimulus, the tax plan, right, good policy. But there's actually a silver lining from growing slower, which I don't think most people realize. And the idea there is that because we're growing slower, we're actually growing more stable, and we think we can grow for much longer. So I actually want you to think that this light blue line could keep extending out, maybe at this slower pace, all the way off the page. We think this is going to be the longest expansion in history. Now, how cycles normally end, a few different ways, but what I just want to touch on is this idea of overheating, right? So sometimes the cycle comes to an end just by the sheer fact that you overheat, right? And what does overheating really look like? Well, the economic equivalent of it, I want you to think of like a cartoon factory with steam blowing out the top, right? Pipes busting, the assembly line moving too fast, right? The factory almost producing too much that it breaks down and it overheats and breaks down. So when we apply that visual to our economy, because that's normally how cycles end, right? That is the norm. 2008 was not the norm. That was the exception. We don't see that, right? We don't see this overheating. So this long, sticky, drawn-out expansion is kind of what we're experiencing and what we expect to continue into 2018. For the first half of the year, we expect growth to pop a little bit from the government policies and then simmer back down to about 2% in the second half of the year. This is the backstop for stocks. This is like the most important thing. If you can take anything from this entire presentation, it should be that if the economy is growing, it is almost impossible for stocks to end negative for the year. There has been 2 exceptions to this rule in the last 100 of years, but I like it because it's a shortcut. It's a rule of thumb. If the economy is growing, it's your backstop for your equities to continue to do positive, right? They might be up 5%, they might be up 20%. That's a different conversation, but you can almost be, I won't use the word guaranteed because we don't use words like that, but it's almost, the probability is that most likely the equity market will be in positive territory for the year if the economy is growing. And that's what we see for 2018. So if we get a little bit deeper into equities on the next page, right, just get a little bit more into fundamentals. If the economy is your backstop, right, which provides almost like your floor, what would drive the market higher this year? Well, that would be earnings, right? I always simply ask, are U.S. companies more or less profitable than they were the year before? Right? It's such a fundamental question, but it's really what drives the market in the medium to longer run. I know noise can drive the market in the short run, but medium run, we want to look at profits. And that's what we're showing on the left-hand side of the page. So this is very vanilla data, which I think is the best type of data. So we're not over-interpreting it. This is just S&P 500 companies' earnings per share, right? And earnings after '08, you can see they fell off a cliff. They grinded higher, right, which supported the market and those really good portfolio returns for U.S. stocks. And they took a little bit of a dip. And I remember when they took this dip, this was in 2015, 2016, people were worried that this was the end. It was called the Earnings Recession. And we were actually saying that it wasn't the end because the economy was growing, right, at that slow, steady, stable pace. And we were right. So it wasn't the economy that caused earnings to slow. It was actually really weak oil prices that hurt energy company earnings, and then a very strong dollar. And U.S. companies are so multinational, when the dollar was strengthening, basically you would have your factories in Europe, right, and you would bring those revenues back to the U.S., and because the dollar was so strong, those revenues were worth way less when converted back to dollars. So that's why you saw that first dip. But now the second extended leg up in earnings has been what's driving the market. And this has been really positive because these earnings haven't been driven by cutting costs. It's actually been by earning more money, like top real line revenue growth. I always compare this back to the household, right? At the end of a given year, you could have more money in the bank if you spent less, right, or cut costs, or you could have more money in the bank if you just earned more. Maybe you worked more, maybe you worked smarter. And it's interesting, both are good, but what we want to see out of stocks, we don't want to see cost cutting forever because it's not sustainable. We actually want to see real growth, right, in revenues that translate into keeping more profit. And that's what you've seen. So earnings growth for this year is expected to be about 15%, which is massive. And that in itself can support the market higher. Now, I know we've had some volatility, especially last week, but I would say that volatility is normal, right? That's just a bit of a precursor, but we're going to get to that page. So if we move to the next page, what has people nervous, though, about U.S. stocks? Because I think right now what I've painted, in the previous 5 minutes has been very rosy, right? The economy's growing. We think it's going to be the longest expansion on record, even if it is slower. Earnings growth is up. Companies are profitable. So I think what puts a little cloud over all of this is just valuations. So the second question we always ask of stocks is, well, are stocks cheap or expensive? And the truth is, this is more an art than a science. That's 100% true. There's different ways to look at valuations. On this page, we're showing forward price to earnings. This is our preferred way of looking at valuations. And if you look at that forward PE measure, right, you want to look at the 25-year average. The 25-year average is 16. We're at 18, right? So we're pushing up above averages, right? Stocks are not cheap. Doesn't matter how you slice it or dice it. Doesn't matter what measure you look at. So this has people worried. But what I would say, first of all, look at this page. Valuations are nothing close to the tech bubble. Okay, not anything near those highs you saw in 2000, 2001. But also, this equity market's very different. This equity market gives you a dividend yield, okay, which that wasn't the case in 2000. So you're getting a bit of income, consistent income from holding stocks. But also, with bond yields so low and cash rates so low, investors who need return are almost willing to pay more for any part of the portfolio that's going to give them return. It sounds a little cheesy, but what I always liken this to is water in a desert. Okay, but in this case, it's not water in a desert, it's stocks in a desert, a growth desert. So I would bet that anybody on this call, myself included, you'd be willing to pay a lot more for water in a desert than you would in any other situation. That is also true of stocks, right? In this lower growth, lower yield, lower interest rate environment, we are willing to pay more for something that gives us growth, gives us yield, and that's stocks. So while this isn't completely like acute crisis, heart attack worthy, these high levels of valuations, because we're all tolerating them and we're willing to tolerate higher valuations, what it does imply is that returns in the future are going to be lower. So we think that at some point, stock market returns simmer down. Okay, they've been fantastic over the last 8 to 10 years, 8 years we'll say. We think going forward they stay positive, but they come down. And partly that's because right now the valuation on the market is so high. So I want you to think of valuations not as a buy or sell signal, even though that's what people think they are, but more as a measure telling you what future returns are going to be like. If valuations are high, future returns are going to be lower, right? You're buying something a little bit overpriced. That's different than when valuations are very cheap, as they were in 08, 09. That told you that returns going forward were going to be higher. If there's any questions on that or want to go into it from a different angle or in a little bit more depth or whatnot, we can do that in the Q&A. And if you turn to the next page, we actually show that visually. So just want to spend a moment on this because I think this is important. So this idea that valuations tell you nothing about returns on the 1 year, but they do tell you something about returns on the 5 year. So on the left-hand side of the page, each dot represents a valuation and then what the 1 year return on the market was. And the whole point is that because those dots are so scattered, there is no relationship. That is actually the takeaway. But contrast that, move to the right-hand side of the page, look at PE and what the subsequent 5-year return was. Well, you notice it tightly fits that line, and that line is downward sloping. So, for example, if you bought it 23 times, right, on the far right of the page, your return ended up being negative over the 5 years. It's not that returns would actually have been negative, but they would have been lower than if you had bought the market at 11 times. Okay? Moving to the next page, I'm actually going to skip that page. We are going to skip page 10. We're going to move to page 11. Let's talk about rates in the equity market, okay? Because there's like this tug of war going on right now. Interest rates are moving up, right? The Fed has been moving rates up slowly, very slowly. And the equity market's also been moving up and doing well. Some people are concerned, right? At what point do rates moving up hurt the stock market as it did in previous cycles? So that's what we're showing on this page. This is so timely, so relevant. Each dot represents a move in the stock market and a move in interest rates. And what we found was kind of interesting that if rates moved up, but the 10-year Treasury yield was below 5%, right, that orange dotted line, stocks actually did well and also moved up. So there was this positive relationship with rates moving up and stocks moving up when you were below 5% on the 10-year yield, right, on your Treasury bonds. And then what happened was if rates were moving up and they were above 5, that's when things got dicey. That's when the stock market started to freak out. Now, something about this relationship has probably changed, right? Rates have been so low for so long. So we put this relationship lower, right? Okay, so we now think that this orange dotted line has been shifted to the left. So we think that stocks are going to do great as interest rates move up until about 4%. Okay, so about a percentage point lower than what we saw in the past. Just to give you a reference point, that 10-year Treasury yield I keep referencing because it's the most important interest rate measure we look at, that measure is at about 2.8 right now. So we've got room for interest rates to move up and the stock market to continue to do well, right? There's still a buffer. I only bring this up because a lot of people feel like the end is really imminent. We just don't feel that way. We think there's so many more positive things that are trumping this idea that rates are moving up. Also, right, a bit of economic history. In previous cycles, the Fed raising rates is what caused the end, right, or kind of kicked the bull market off the curb. We don't think that's going to happen this year, right? So we're still very positive on stocks and why you actually have to have them in a portfolio. If we move to the next page and just go a little bit deeper on the Fed, let's talk about this for a second. So the Fed is moving rates up slowly, slowly, and that's what we're showing on this page. And what's really interesting is that if you follow the gray line when it diverges into two lines, the blue line is what the Fed tells us they're going to do, right, because they provide a lot of communication to the market. The brown line is what the market thinks. There is not a big gap between these two lines. That is a good thing. If I was to show you this chart, because we update them monthly, a year ago, there was actually this massive gap between the two lines. And that signified the idea that the Fed and the market were on completely different pages. That would have been no good if that continued. But these lines have closed. So what the Fed says they're going to do, the market's like, I kind of believe that. We can get behind that. And that's really key because then it means there's no shock, there's no awe, there's no surprise. And the Fed just does their thing and the market in turn, right, follows suit. So this is a pretty big positive, and this ties back to what we were talking about before as to why we don't think the Fed is going to make a big mistake. They've really changed their MO. The Federal Reserve is all about being transparent, being communicative, just being clear with everybody so that we're all on the same page. If you move to the next page, what else is the Fed doing right now? Well, the Fed is doing this thing called rolling off the balance sheet. There's like a very technical official name for it, but I can't remember it. And what they're doing is they're taking their bloated balance sheet and they're unwinding it slowly. This is also a good thing, right? This means in some sense we're getting back to normal. And I know normal is very much a relative term, but after 2008, the Fed basically bought up all these assets. This was pretty contentious. Some people really agreed with it, some really didn't. And what you can see when they're buying all those assets is they bloated up their balance sheet, basically all these financial assets they were holding. They had good intentions with what they were trying to do, but I always liken it to giving someone who's not sick medicine, right? Which is obviously not something you want to do. Now they're weaning off the medicine, okay? The economy was really the patient. And at first this made a lot of sense, but as we talked about before, we've been growing. Yes, we've been growing slower, but we've been growing steady and stable, and the medicine hasn't really been warranted. Now they're weaning off. That's where you can see the sloping down of the balance sheet. So this is a good thing. We're heading back to what we would have considered normal with what a central bank does. Also, if there's any more questions specifically on this, we can talk about that and what's really happening there during the Q&A. If we go to the next page, right, just thinking about the yield curve. So many of you are probably familiar with the idea that as rates go up, which is what we're showing on this page, right, interest rates are going up, the yield curve, that tends to not be the greatest thing for fixed income in the portfolio, right? They've got that inverse relationship. Rates go up, bond prices go down. So this has some people worried, well, if bond prices shoot up, or excuse me, if rates shoot up, bond prices are going to fall to the floor. We don't think that's the case because we think everything is happening in this like slow, sticky, drawn out way. Is it going to be a little bumpy? Is it going to be a little volatile? Yes. But rates moving up slowly means that everything in the portfolio can kind of adjust accordingly. What really happens, what you don't want to see is big, sharp moves, right? Markets don't like big, sharp moves and they don't like surprises. But if everything's telegraphed and if everything happens slowly and steadily, then we can all kind of process that a bit better. And you don't have to get a bear market in fixed income. We like to say that we don't think it's going to be a grizzly bear for fixed income with rates moving up. We think it's going to be more of a koala bear. So still a bear that could maybe hurt you, but cuter and fuzzier and way smaller. If we move to the next page, this is actually by far my favorite concept because out of everything we just talked about with respect to the Fed and rates and the balance sheet, what I'm about to talk about is actually most relevant for everybody on the call, including myself, and that is the rate that cash returns, right? So on the left-hand side, and the Fed controls this basically indirectly, but on the left-hand side, all we're showing is income earned on cash, okay? That's the gray bars. So if you took $100,000 and you invested it in a 6-month CD, this was average rates we aggregated across the United States. That gray bar was what you would have been returned, right, on your investment. And you can see that in the 90s and the 2000s, you were actively very rewarded for holding cash, right? Those gray bars, you know, quite a bit. That has obviously fallen very dramatically as the Fed took rates down to zero. And the key point is that even as the Fed continues to raise rates, because in 2016 they raised rates too a few times, these gray bars are not going to go up enough, and they're not going to go up dramatically enough to make cash really attractive again. Does cash have a place? Absolutely. It has a place in the portfolio. It has a place in the emergency fund. We completely acknowledge that. But we know of too much cash sitting on the sidelines earning nothing. And what's interesting is that we added these light blue bars on the page, and the light blue bars show the income you needed to beat inflation. Okay, so on $100,000, if the inflation rate was 2% last year, you needed about $2,000 you needed to earn just to keep up with inflation. Well, if you actually look at the little gray bar, it's well below the light blue line. So last year that cash returned $338, so nothing basically. And you needed $2,000. So you lost, if you were holding this position, right, you lost almost $1,600 in purchasing power. And that doesn't feel real. And I get that. It doesn't feel like you lost $1,600 because, well, if you had $100,000, you would have had $100,000 and $338 at the end of the year. But it is a real loss, right? Especially, again, this idea when it compounds year after year after year. And we know medical care inflation runs well above 2%. It's about 5%. Education inflation runs at 6%. All the things that we actually buy day to day are going up in price. This is just the broad line inflation level that we reference. So I almost want you to picture in your mind a dollar bill, right? And I know a dollar bill from last year feels, looks, smells the same, but you can almost visualize cutting off a little piece of the end every single year. That is really what is happening, what inflation does to money. So we are big believers in being invested, and there are smart, sound ways to be invested. That's like why you utilize, Carmen and the team, right? Why you have a financial advisor. This is the real reason to be invested. So I just wanted to point that out. That's a little bit more on the portfolio side, but I think it ties so well into the Fed because we talk ad nauseum about the Fed raising rates, but the truth is the way it actually affects everybody in the most real way is through this cash chart we're showing on the left. So we are going to skip over the next page and talk about fixed income sector returns on page 17. Fixed income investing is getting a little bit interesting with rates going up, as we talked about, but there's this key idea of diversification, which is held through always probably in your broad portfolios, right? You would never just want to own one single stock. You'd always want to have a basket of stocks. Or if you're going to have a single stock, you want to have a bunch of different single stocks. And that's diversification in a nutshell, and that's always provided a smoother ride, a better return, just better planning. So that concept, which we've always applied to portfolios for decades, has now become really more relevant on the fixed income side as well. And that's what we're showing on this chart. So I wouldn't expect everybody to know every single one of these little dots, but what I want to point out is that fixed income, just like stocks, obviously has so many different types, right? There's the whole gambit. There's treasuries, right? If you focus, there's mortgage-backed securities, there's municipals, there's TIPS, there's emerging market debt, right? And that's what we're showing on this page. We're ranking the returns in a given year. And what I wanted to point out was that if you looked at a diversified fixed income portfolio that would be nestled within your portfolio, that's the gray squares. And the asset allocation, right, so that diversified fixed income part of the portfolio is never at the top and it's never at the bottom. Okay, it's never the best, it's never the worst, and the truth is that's okay. And in the kind of environment we're heading into, well, we've been in for a couple of years with rates going up, that's been a perfect place to be, trotting along the middle with your fixed income. Because anyone who's made really strong calls on interest rates either shooting up or falling down, it hasn't worked out because rates have been a little unpredictable. Yes, we know they're going up, but we think they're going up slowly. So I just wanted to point that out. I think we should change gears a little bit in the last 5 or 6 minutes and talk about the global economy because there's a lot of exciting things happening there. So on the next page, we're showing really interesting data from around the globe, manufacturing momentum data. And this is really interesting because manufacturing tends to lead growth. It's a leading indicator. And what we're showing on this page is for a bunch of developed and emerging market economies, what's the manufacturing momentum look like? And what's interesting, this is by far my favorite data. Green means good, orange means bad, yellow means okay. This data is very micro. So what we do, well, what PMI does is they go into these countries and they poll 5,000 of these purchasing managers. And purchasing managers are very interesting because if they're not good at their job, they get fired pretty quick. So what a purchasing manager is responsible for doing is forecasting the demand of something and making sure that there's enough supply to meet it. So think of an iPad factory, okay? The purchasing manager for the iPad factory has to forecast iPad demand in the region, make sure that they have enough workers, enough shifts, enough product completed at the end of the month to meet supply. And what this data company does is they'll go in and they ask all these purchasing managers interesting questions like, are you hiring? Are you expanding? What are you seeing with orders? How do people feel? Are you firing? Right? So this whole gambit of questions, they then roll it up into this data And this is what you're seeing on this page. So this has been a really reliable indicator. And the punchline is there's a ton of green on this page. And you'll have to take my word for it, but this was not always the case. So this data only goes back to 2016. There's a ton of green, especially in Europe. And if I was to show you the panoramic version of this chart that went back all the way to 2012, there was so much red and yellow on the page, right? We weren't all growing. It was really only the US. The US was the only game in town. Now the US is still growing, amazingly, right? Very stable, but the rest of the world is picking up. And this is good for international stocks in your portfolio. This is good for international bonds. This is good for everyone, right? Nothing about growth is a zero-sum game. And I always feel remiss if I don't point that out. So I want you to think of it like a block of houses, okay? And the price of the U.S. house has been going up since '08, right? U.S. house, fantastic, best house on the block. But if you were to ask any real estate agent what's even better for just, than just your house going up in price, would be if all the houses on your block, all the houses in your neighborhood were also going up in price, right? There's synergies and positive externalities from this. And that's kind of what's going on with the global economy. It's really just a block of houses. So this has been good for the U.S. This has been good for everyone. And just to kind of show and kind of hit home the idea that it's not a zero-sum game, right? Just because China's growing faster doesn't mean we have to grow slower, or just because Europe's doing better means that, we have to grow slower. I just want to highlight a point from 2017. So for 2017, the U.S. exported 6% and imported 2.5%. Okay, and at the beginning of the year, we thought we were going to export 2.5, import 2.5, and it was just going to be, net, even keel. We ended up exporting so much more than we thought, and that had to do with the fact that the economy outside the U.S. was growing, right? And they were buying more of our stuff. So this has been really good for U.S. multinational companies, and frankly, it's really good for everyone when the global economy is picking up, and that is the case, and that is another reason to feel very positive. Not just on U.S. stocks, but also on international stocks, right? We think we're in the second year of a 3-year uptick, a 3-year oomph for international stocks to do really well. And we highlight that actually on the next page very well. So on this page, all we're showing, the gray line is the S&P 500, which you can see, right? Price of the U.S. house has been grinding higher for 8 years. Whereas you compare that to the rest of the world, right? That purple line, which represents the international stock market, excluding the U.S., that had basically been moving sideways, doing nothing for about 7 or 8 years. That started to break out last year, and we expect that to continue into 2018. Actually, and we expect it to continue into 2019. But this is something we've been talking a lot to clients about because so many feel like they've missed the boat, right? Like 2017 was such a good year for international markets. Did they miss it? No, you have not missed the gondola, is what I've been saying. We're just starting, we're in the beginning of second year of a 3-year uptick for international markets. So I am actually going to end there. I had added in a few more slides, but I think that's a good solid amount of content. We talked about the U.S. economy continuing to grow, mind you, a little bit slower. Maybe we get the oomph from good policy. We also talked about equity markets and this idea that earnings, right, are going to drive the market. That's the heart of it, and those look so good. Valuations, which, not as positive, don't actually act as a buy or sell signal. They just tell you something about future returns being muted. We also talked about the idea that interest rates are moving up, but it's happening slowly. If it continues to happen slowly, and if the Fed and the market are on the same page, then this doesn't have to spook the market or melt down the equity market. We also talked about the idea of cash, right? Cash has a place in the portfolio, has a place in an emergency fund, as we talked about, but noting that even with the Fed raising rates, the return on cash is not going to go up significantly anytime soon. And that's something to keep in mind when you're thinking about a plan, a financial plan. And lastly, we ended on the international landscape, right? The global economy is growing, and that is good for everybody, and it's about time. We were all really in sync pre-08. I would say after 2008, the world economy's been off kilter. It's been out of sync. The US has been growing and everybody else had been floundering. Well, it makes sense now that everyone's on a cyclical upswing and the US is just continuing to grow in the background. And that is good for the US and good for US stocks because of the trade dynamic, but it's also good for international markets. And that's something that we see as a huge opportunity in 2018 and 2019. So I'm going to end there, turn it back to Carmen, and see if there's any questions from anybody on the line. Are there any questions? Do we have any questions? Okay, so I'm getting the sense that we covered a lot and we didn't actually have any questions in the queue. So I want to thank you all for your time today, listening to our 2018 market view and just hearing what JP Morgan has to think about markets and the economy in 2018.